Hey guys, welcome to the Friday wrap. Okay, last week we got some really positive feedback and I mentioned that we'd dig a little bit deeper into this interest rates and inflation process. And so that is what we're going to do today. Let's get straight into it. Interest rates part 2. All right, as usual, we have the general advice warning. Please don't go and run off and make a decision based on what we talk about today. If you have some questions, give us a call. We'll go through your situation and talk more about you. Interest rate increases. We are now on a journey of interest rate increases. First one happened on Tuesday. The RBA increased interest rates by 0.25 from the low of 0.1, so we are now at 0.35%. I mentioned last week that the last rise we had was in November 2010, 12 years ago. So for many people, this interest rate rise is going to be the first time they've experienced a rise in a home loan. I'm 42. I had my first home in about 2007 and there were a couple of rises. So I experienced it. But for people, mid-30s down who have property, they've never experienced a time when interest rates have risen. And unfortunately for borrowers, that is where we are now at. There is expected future rates over the short to medium term coming our way. All right, we talked last week about how interest rates are used to affect inflation. Let's have a look. Every 3 months, the Australian Bureau of Statistics, the ABS, determines what they call the Consumer Price Index, the CPI, all these acronyms. It's used to measure a basket of goods or the change in price of a basket of goods. CPI is measured by about 100,000 prices of goods, and the change of those talks about the change of CPI, change of Consumer Price Index. If you follow the headlines last week, you would have seen that there was inflation at 5.1%. I talked last week about the fact that they want to keep this inflation between 2 and 3. 5.1 is a whole lot higher, but that's not necessarily the number they use. They're more about this underlying inflation, which they call the trimmed mean. That came out at 3.7%. And the reason for using this number is because it takes out any changes of goods which might be significant and temporary. Example, petrol, which I said last week, has gone up significantly. Banana prices increased 400% after cyclones in the region of North Queensland, back in 2006. So you're going to have moments in time where the price of goods can increase or decrease significantly, but if you take them out, as you can see, the change can be significantly different. So we want to be acting on more relevant and actual numbers. All right, so one of the questions that somebody rang me about last week and said, if we've got a situation where the prices of goods, the cost of living in general is increasing, why are they increasing interest rates? Because that's only going to add to our pain. Let me explain. This is what I want to dig deeper on this week, okay? So let me go through each of these points. There's a couple of pages of them. Buckle in. Rising interest rates means people with debt have to pay more on their monthly, weekly, whatever it is, on their loan, okay? It means they've got less money to spend however else they would like to. I have told you enough times now, everyone spends all their money. So if they've got their situation, they've received their income in, and then they've got this first chunk that comes out, which is their repayments on their loans, it's going to be a tiny bit more than it was last month because the interest is a tiny bit more. It means they've got a little bit less left. With that little bit less, they don't have as much to spend in the economy, not as much money is going into the economy, so prices of goods are not increasing as fast because the demand is not there. Additionally, if the interest rates are higher, people may think twice about borrowing to purchase things because it's harder to pay off, okay? So, moving on. At any given time, we only have an ability to produce so many goods, okay? And that's what we all want. If we've got an ability to buy everything it is we want, but there's only so much that we can get, what are we doing? We're competing with each other to try and get that. We're trying to climb over each other to get the product. And in doing so, the seller is able to increase their price up to the point where nobody wants that. And then once you get to that point, that's what it's worth. And prices have increased and increased. That's what we've just covered on this page. Now, you imagine a situation where everything, our cost of living has increased. What are you going to do about it? One of the things you can do is go to your boss and say, hey boss, everything's more expensive. You're selling your goods for more. Can I get a pay rise? If we lived in a world where unemployment was high, your boss could go, well, you know what? I can replace you easily enough. I'll find somebody else to work on the current one, on your current wage, and we don't have to increase wages. At the moment, unemployment is relatively low. It's at a level of 4%. I'll do unemployment next week. I'm starting to learn all about this and I'm quite interested. So next week's Friday Wrap, unemployment. But this week, employment rates are low, or unemployment rates, are low. So your boss can't go out and find somebody to replace you. So he might have to increase your wage. So if he's increasing your wage, how do you think he's going to cover the increased cost for his business? He's going to increase the product or increase the cost of his product. So again, we pay more and we're on this endless cycle. And that is why the government has to increase interest rates to give us less cash flow so we don't have as much money to spend. There's less demand in the economy. The prices of goods can come down or back within that region of 2 to 3%. What is the worst case scenario? Zimbabwe, a number of years ago, experienced hyperinflation and they had a $100 trillion note. That is as bad as it can get. In researching this, I was looking at this Zimbabwe situation. There were times when during the day, the prices of goods continually increased. You would have to buy goods in the morning because they'd be more expensive in the afternoon. That is inflation at its worst. And does it work? Well, back here, let's call that 1993. The early 90s is when they introduced this target between 2 and 3%. And you can see it was a little more erratic prior, got to this point where they introduced a target, and we've now pretty well stayed within that band. That, guys, is my Friday wrap. Interest rates, inflation. I hope you've learned a little bit about it. Next week, we'll have a look at unemployment and that figure of 4% and what it means. We'll dig a little bit deeper into that. Hope you enjoyed it. I've enjoyed it. Have a good one, and we'll talk soon.